Welcome to our Research and Development Tax Credits webinar. KBKG was established in 1999. We have offices across the U.S., including Illinois, Pennsylvania, Arizona, Ohio, Georgia, New York, Texas, and Pasadena, California, where we are headquartered. We provide turnkey tax solutions to CPAs and businesses. Our engineers and tax experts have performed thousands of tax projects, resulting in hundreds of millions of dollars in benefits for our clients. Our team is a diverse mix of tax professionals, attorneys, engineers, and economists from various disciplines. This combination of talent allows us to be the best at what we do and maximize results for our clients. KBKG is a preferred provider for thousands of CPAs across the country. Now I'm going to introduce our speakers for today. Michael Maroney is a director with KBKG and advises clients on tax related to federal and state research and development tax incentives. He has over 20 years of experience working on tax reviews ranging from sophisticated multi-year claims to consulting projects. He has advised numerous Fortune 500 clients across a variety of industries, including aerospace and defense, agriculture, pharmaceutical, communications, industrial products, consumer goods, software technology, and energy. Other is a senior manager with KBKG working in the Research Tax Credit Department. She has 8 years of consulting experience providing R&D tax credit services to companies ranging from architectural and engineering, food and beverage, software development, cosmetics, manufacturing, automotive, and aerospace and defense. She received her Bachelor's of Science in Biology from the University of California, San Diego. Now I'll turn it over to our speakers for the presentation.
Here's the agenda with the items we're going to cover on this webinar. We'll start with a brief legislative update. Next, we'll discuss the R&D credit opportunity. Then we'll cover the tax definition of R&D activity. We'll explain the 2 federal calculation methods and walk through a couple examples to show the mechanics. Then we'll wrap up discussing tax planning and audit strategies. Finally, I would encourage you to submit your questions in the chat box, and we will answer as many as we can go. Let's get started. The Section 41 credit for increasing research activities was originally enacted in 1981. At the time, it was a temporary code section and stays as such until it was permanently extended as part of the PATH Act of 2015. The Section 41 credit is a federal statute. However, most states offer some form of research credit that borrows from the federal statute. Although there are billions of dollars worth of research credit claims every year in the United States, there are still billions of dollars of credit that go unclaimed. This is primarily due to many taxpayers not being aware of the credit or not quite understanding it. This webinar will attempt to clarify some of the nuances of the R&D tax credit. The PATH Act made 3 very important changes to the R&D tax credit. First and foremost, the R&D credit has now been permanently extended, allowing taxpayers that have traditionally taken advantage of the credit can continue to do so. The second big change is that the R&D credit can now be used to offset a portion of payroll taxes for qualified small businesses. And lastly, qualified businesses can now use the R&D credit to offset alternative minimum tax. Effective for tax years beginning after December 31st, 2015, qualified small businesses can now use up to $250,000 of research credits to offset a portion of their payroll tax. A qualified small business is defined as a person or entity with less than $5 million in gross receipts and no gross receipts before the 5-year period ending with the current period. For example, if a taxpayer wanted to make the election in 2020, the taxpayer could not have had gross receipts prior to 2016. If the taxpayer had gross receipts in 2015, this particular taxpayer could not make the election in 2020. Additionally, taxpayers cannot make the election for more than 5 years. Please note, gross receipts are not required in order to make the election. Therefore, a company that has no gross receipts but does have payroll taxes and a research credit can make the election. If a company is not a partnership or S Corp, only the amount of the R&D credit carried forward can be applied to offset the payroll tax. The election starts the first quarter after the federal return is filed. If a taxpayer files their 2020 tax return in March of 2021, the election will apply to payroll taxes beginning in the second quarter of 2021. Startup companies in a multitude of industries are great candidates for the payroll tax offset. For example, startup fintech, biotech, and software development companies should review their potential as it pertains to the research credit. Generally, these startup companies are in a taxable loss position and not generating a tax liability. Now the credit can be used to offset the payroll tax expense and generate a large cash benefit. Here's an example of how the payroll tax election can help a qualified small business. In this example, a software developer began operations in 2019. The company is made up of 15 individuals and did not receive any gross receipts until 2020. In 2020, the company had $800,000 in gross receipts, qualified wages of $2 million, resulting R&D credits of $200,000, and a payroll tax liability of $125,000. This company will file their 2020 tax return in March of 2021. Prior to PATH Act, this taxpayer could have claimed the research credit, but will not have been able to use any of the credits until they had taxable income. Due to the PATH Act, they will be able to offset the qualified portion of their payroll taxes in the second quarter of 2021. Any unused credits will be carried forward to subsequent quarters until fully utilized. The AMT provision in the PATH Act is equally as valuable to taxpayers. Prior to PATH Act, research credits could not be used to offset alternative minimum tax. Taxpayer and AMT were forced to carry their credits forward until they came out of AMT. Eligible small businesses defined as averaging less than $50 million in gross receipts the previous 3 years can now use the credit to offset AMT for tax years beginning after December 31st, 2015. This provision is similar to a previous small business provision enacted in 2010. One item to note is that AMT reduction is not available to publicly traded companies. Prior to PATH Act, taxpayers that had an AMT liability could not use a research credit to offset taxable income. In this example, the taxpayer generated a research credit of $300,000. Their tax liability is made up of $158,000 of regular tax liability and $23,000 of AMT liability, which amounts to $181,000 of total tax liability. This taxpayer could not use any of their credits in 2015 and were forced to carry their entire R&D credit forward. For the tax years beginning in 2016, the taxpayers and AMT are now able to use the research credits to offset their tax liabilities. In this example, the taxpayer generated $331,000 in research credits. Their tax liability is made up of $188,000 of regular tax liability and $31,000 of AMT, which results in $219,000 in total liability. Applying the Section 38 rules, as well as the new rules surrounding the PATH Act, allows the taxpayers to offset about $178,000 of tax liabilities. Prior to PATH Act, this taxpayer would have had to carry their entire research credit forward. As a result of the new rules, this taxpayer will offset a large chunk of their tax liability and carry forward the excess credits. By eliminating the AMT's tentative minimum tax for corporations, the law allows a research credit to reduce a taxpayer's liability down to 25% of the amount of net regular tax liability that exceeds $25,000, a limitation imposed by Section 38. For example, 188,000 minus 25,000 equals 163,000. Multiply that 25% is at about 40,000 total tax liability after the credit.
So let's dig into what is the R&D credit opportunity. The R&D credit is a general business credit, and as such, it provides a dollar for dollar reduction in a taxpayer's income tax liability. The credit is subject to IRC Section 39 carryback and carry forward rules. So as such, any unused credits can be carried back 1 year first, and then forward for up to 20 years for federal purposes. The credit is available to corporations and individual business owners, as well as pass-through entities, such as S-corps or partnerships. And in the case of those pass-through entities, the benefits flow through to the individual shareholders on each shareholder's respective K-1. So here's a chart that represents the total amount of the federal R&D credits claimed since 2005. It's estimated that over $19 billion of R&D credits will be claimed by companies in 2020. And here's a chart that represents the size of those businesses that are claiming the R&D credit. Roughly 87% of companies claiming the credit have revenues in excess of $100 million, while the remaining 13% is split between companies with revenues less than $100 million and less than $10 million, respectively. Now, there's no cap on the amount of the credit at the federal level, so we encourage you that if you have a client or if you are a business that can benefit from the R&D credits, make sure that you're aware of this benefit. And with changes resulting from the PATH Act, as Elise outlined, we anticipate that more small and mid-sized businesses are going to be claiming a larger share of this pie going forward. So now would be a great time to revisit this with your clients, make sure that they're aware of the opportunity and not missing it. Now, the federal R&D credit offers roughly 6.5 cents for every dollar spent on R&D activities. In addition to the federal credit, many states also offer an R&D tax incentive as well, mostly for R&D taking place within the state. And these are only a few examples. The methodologies vary, but most follow the federal definition as well as the federal calculation with variations on the credit rates, the refundable nature of the credit, as well as any carryback or carry forward provisions. And as of this year, these are the states that currently offer an R&D credit. Most of these states offer a credit on the same qualified expenses claimed for the federal credit and may be claimed in addition to the federal credit. So if you or your clients are conducting R&D within any of these states, make sure you're looking into the state R&D tax benefit as well. Something to note here, Arizona and Illinois both extended their credits. Arizona through December of this year, through December 31st, and Illinois through December 31st, 2026. Oregon's credit is expired as of December 31st, 2017, so its R&D credit applies to only to open tax years. And most recently, Virginia extended its credit through January 1st, 2025, and it also increased the total amount of the credits available. Now, R&D credits can be found in almost any industry. This is just a list of some of the industries where research credits are readily identified. Basically, if your client is developing something new or improving an existing product or process, regardless of the industry, they are conducting R&D activities eligible for the credit. Now, this slide shows the most popular industries where companies are taking advantage of the federal R&D credit. It's probably no surprise that manufacturing leads this list, followed by software developers, and then engineering and scientific services. So you'll see that the vast majority of the R&D credits being claimed are in those top three industries. So if you or your clients fall within any of these industries on here, there is a benefit to look into. Now, this slide shows a short list of some of the studies we've conducted. And I don't show you this slide to brag. I really want you to pay attention to this slide more than any others to just see, are your clients or are you as a business doing any of these types of activities? Because if you are, these are the industries and these are the activities that we have successfully been able to claim for the R&D tax credit. So let's go through some of these, starting at the top with formulations. So if you're formulating either new organic foods, spices, beer, or wine, if you're experimenting with new ingredients and new processes or techniques, you can claim the R&D credit for those activities. In manufacturing, the design and testing of new prototypes or experimenting with new processing techniques in order to gain a competitive advantage, those activities qualify as well. In software development, whether it's developing software for back office applications, video games, mobile or web applications, or computer animation, those activities can qualify as well. Defense contractors can qualify. You know, it's a misconception that if the government is paying you for the R&D that you are performing, that you don't qualify for the credit based off of those expenses, and that is simply not true. So if you're a defense contractor developing parts for systems or ships or planes or vehicles, those activities can qualify also. Pharmaceuticals, if you're a pharmaceutical company developing drug formulations or conducting testing for humans or animals, those activities qualify as well. And then in the mining industry, whether it's developing innovative extraction techniques or delivery processes for the oil and gas industries, those activities qualify for the credit as well. So next, Elise is going to discuss what activities and who qualifies for the credit. Elise?
Thanks, Michael. So often when a reference is made to research and development, taxpayers think about lab coats and test tubes. In reality, the R&D credit tests are much broader in application, and provided we meet the following tests, we have an opportunity to claim the tax credit. For activities to qualify for the research credit, there are 4 tests that need to be met. These tests are applied at the business component level. It's important to note that a business component can be defined as a product, a process, technique, a software, or a formula. The first test is called technological in nature. The project must fundamentally rely on the hard sciences, such as physical science, biological science, computer science, or engineering. The second test is permitted purpose. This has to do with the objective behind the research. The objective must be to improve the functionality, performance, reliability, or quality of a new or existing business component. The third test is called elimination of uncertainty. At the outset of the project, there must be a degree of uncertainty related to the appropriate design of the business component or the capability or methodology for improving the business component. The fourth test is process of experimentation, which works hand in hand with elimination of uncertainty test. This requires that substantially all of the activities must constitute a process of experimentation, which is defined as the evaluation of different alternatives to eliminate the technical uncertainty identified at the outset of the project. To the extent a project meets all 4 parts of this test, we are able to capture the expenses associated with the project towards a research credit. Generally, there are 3 types of expenses which qualify for the research credit. They are wages, supplies, and contract research. Qualified wages are generally defined as the qualified portion of an employee's W-2 Box 1 amount. Qualified supplies are items that are used and consumed in the research process. For example, materials used in prototypes. Supplies cannot be capital in nature. Therefore, taxpayers cannot qualify land or machinery or equipment. Additionally, general and administrative expenses such as travel, meals, and entertainment, and telephone expenses cannot be captured as qualified supplies. Qualified contract research are 65% of the payments made to third parties for purposes of qualifying research. So now that we know what qualifies, it's important to understand who qualifies. There are 3 levels of qualifying activities for employees. The primary level would be the individuals that are engaged in the qualified research. These are the individuals that are working directly on the project. From there, taxpayer can capture 1 level directly above and 1 level directly below. 1 level above would be the individual that are directly supervising those personnel. 1 level below would be the individuals that are directly supporting the personnel. Generally, any payments made to the third parties for conduct of research on our behalf are eligible to generate research credits. It's important to note payments for contract research are subject to a statutory reduction. This reduction is 35%, but may vary depending on the type of organization. Now we'll go over a few qualified examples for employees. Direct supervisors can have both direct activities and direct supervision qualified time. Examples are reviewing technical designs, communicating requirements, and direct support examples are test lab equipment cleaning by facility maintenance staff, compiling research data, and creating experimental models. The determining factor for qualification is the nature of activity to which expenditure relates. Qualified activities are applied at the business component level. Qualified research activities are defined by the 4-part test we just went over. There is something called a shrink back rule, which allows you to apply the qualified activities to the business component as a whole, or to shrink it back to the smaller, distinct components which make up the product, process, formula, or software. Examples of qualifying activities can fall under several categories, and this list is certainly not all inclusive. Included in this list are activities in the design stages of project, including specification design, technical design work, CAD design work, and modeling and analysis. Prototype development, which includes the design and construction of test product, is also qualified activities. Testing and experimentation, including computer modeling and simulation, prototype testing, and field tests, are also qualified activities. It's important to note that success is not required in order for the project to qualify. In fact, when a development is unsuccessful from technical perspective, it makes the uncertainties associated with the project that much more obvious, and we can capture all the costs related to it. Non-qualified activities include any activities that take place outside of the United States. Additional examples include any adaptation of an existing business component, any duplication or reverse engineering of an existing business component is also non-qualified activities. Any activities around the social sciences or humanities, studies related to efficiencies, management operations, or profitability is also examples of non-qualified activities. Any routine data collection, routine or ordinary QA testing is also non-qualified activities. Also, funded research. The taxpayer must retain at least shared rights to the technology under development, and the taxpayer must also be deemed at risk for development. It is deemed funded when the taxpayer is paid by customer under time and material terms. It is deemed funded research if a taxpayer pays its contractors to perform research under firm fixed price terms. Additionally, non-qualified activities include activities that take place after the project is ready to be commercially released. The following activities are deemed to occur after commercial production: pre-production planning, pre-production tooling, trial production runs, any troubleshooting production equipment, accumulating data relating to production, debugging flaws in business component after it is commercially released.
All right, so we're going to get into now how to calculate a credit using both of the credit methods available, and we're going to talk about, we'll do a couple of examples to show you the mechanics of those calculations. So first, the R&D credit components here. So the federal credit is calculated as the sum of 20% of the company's qualified research expenditures, or QREs, over a base amount, plus 20% of basic research payments. These are payments that are made to tax-exempt organizations performing research on your behalf, such as universities or scientific research organizations. Plus 20% of payments made to an energy research consortia. Now, these are tax-exempt organizations as well. They're focused on performing energy research, typically funded by a small group of taxpayers with an interest in the results of that research. Now, the credit is based on the qualifying activities conducted by the company or by those that the company pays to perform research on its behalf. This is primarily a wage-based credit. So think of that when you're doing your scoping as to whether the candidate is a good candidate. About 75% on average of the credit is generated by employee wages. The other is split kind of evenly between supplies and outside contractors. The credit is incremental in nature. Now, what that means is that you don't get the credit necessarily on the amount of money you're spending in a given credit year. You get the credit based on the difference or the incremental R&D spend that you spend in the credit year over the base amount. All right. We're going to see when Elise talks about the alternative simplified credit method that companies that experience flat R&D spend or even slightly decreasing R&D spend can still take advantage of the credits using the ASC method, and that'll be discussed, as I said, later in the presentation. So there are two federal calculation methods available: the regular credit or the alternative simplified credit, the ASC. Now, both methods require calculating a base amount, which a company's current R&D expenses must exceed in order to claim the credit at the federal level. Now, for the regular credit, this base amount focuses on years 1984 to 1988. If alternatively, if the company was not around during that time, or if it was not performing qualified research during that time, then the base period shifts to activity occurring after 1993, and that's called the startup calculation, if you're looking for the instructions on how to do that. Now, for the alternative simplified credit, or the ASC, the base amount involves only the 3 prior years' qualified expenses. Now, the election as to which method you want to choose is made each year on an originally filed tax return. Once made, the company is stuck with that election for that tax year. So if the taxpayer wishes to change its calculation method for a future year, it can. It just needs to be done on that original return. However, when you are amending a prior year return to claim the R&D credit for the first time, you can select either method at that point. Now, for the regular credit method, there are 4 items necessary to calculate the credit. First is the qualified research expenses, or QREs. The second item is the average annual gross receipts for the 4 prior years. The third item is the fixed base percentage, which is calculated as the ratio of aggregate QREs over aggregate gross receipts for a specific period of time. And the maximum fixed base percentage allowed is 16%. Number 4 is the base amount. So you calculate the base amount by really comparing 2 different calculations. First, to determine the base, you compare the 2 numbers. You multiply your average annual gross receipts by your fixed base percentage. And then you compare that to 50% of your current year QREs. And whichever number is greater, is your base amount. This is the amount that your current year QREs must exceed in order to get a credit. And then at that point, the credit rate is then applied to this amount to arrive at your final credit. So this just as an example, it's an illustration of a fixed base percentage calculation. This assumes a base period in the years 1984 through 1988, which again means that the company was conducting research activities in at least 3 of those 5 years during this time period. And in our example, they have qualified research activities and expenses in each of those 5 years. So to calculate the fixed base percentage, we total up the QREs for these 5 years and divide by the total gross receipts for the same period. And for members of a controlled group of companies, QREs and gross receipts for each member of that controlled group must be included in this calculation. So I'll just emphasize that here, that it's not just the companies in this controlled group that are performing research that you include the gross receipts for. It's gross receipts for companies that even aren't doing any research. They're still part of that controlled group, and that gross receipts will actually raise the bar that you have to clear in order to claim the credit in this regular credit. So in this example, the fixed base percentage is 2.3%. So in the next example here, we've got a company with a current year R&D spend of $3 million. The average annual gross receipts for the 4 prior years are $75 million. We next compare the tentative base amount to the minimum base amount. The tentative base amount is $1.7 million, which is 75 million times the fixed base percentage of 2.3%. Comparing this to the minimum base amount, which is the $3 million in QREs multiplied by 50%, we see that the tentative base amount is larger, and therefore we use that as our base amount. Subtracting the base amount from our current year R&D spend yields 1.2 million in incremental R&D. We multiply this by the 20% credit rate to get the gross credit, and then again by 79% if the IRC Section 280C reduced credit is elected. So let's explain a little bit about what that 280C reduced credit election is. It's available for either method, the regular credit or the alternative simplified credit. But in general, if you claim a credit, that the gross credit, let's say, if you claim a credit, it must be claimed that the amount of that credit gets added back to income. You pay taxes on that, and the theory is that the credit is going to more than offset the amount of the additional tax you would pay. Anything left over gets applied to that to your original tax liability on that amended return. Now, so let me just say this, the gross credit must be claimed on an amended return. Another way of saying that is that the 280C reduced credit is only available on a timely filed original tax return. If the gross credit is claimed on either an original or an amended return, you must reduce the amount of the company's deductible expenses by the amount of the gross credit. So to avoid this, it is generally advantageous for companies to elect on an original return the 280C reduced credit, which reduces the credit by 21%, but requires no adjustments to be made for the deductible expenses because the credit and a deduction cannot be claimed on the same R&D expense.
Now let's look at alternative simplified credit or ASC method. The ASC is calculated by applying a 14% credit rate to the current year QREs that exceed a base amount. The base amount is the prior 3 tax periods. As such, a major benefit to using the ASC methodology is that it requires much less historical documentation. The ASC may be a great option for older companies which may not have records to support their regular research credit, base period, and fixed base percentages. Furthermore, companies with large gross receipts amounts in recent years could benefit from the ASC methodology. Large amounts of gross receipts increases your regular credit base amount, which reduces your credit. An important item to note is recent law change allows companies to amend returns to claim the ASC. Where the regular credit required a fixed base calculation and average annual gross receipts, the ASC method needs only QREs, wages, supplies, and contract research for the credit year and the 3 prior years. The base amount is calculated by simply taking 50% of the average QREs for the 3 prior years, subtracting the base amount from the current year QREs, and multiplying by 14% is the amount of alternative simplified credit for the current period. So in this example, we have a company with 3 million of QREs. Its base amount is about 1.1 million. That leaves current year QREs available of 1.8 million. We then apply the 14% credit rate and get alternative simplified credit of roughly 262,000. If we elect the 280C reduced credit, this reduces the credit by 21% to 207,000. Remember, the 280C election is only made on an original return and provides an easy way to avoid having to make adjustments to deductible expenses. It also provides you a lower starting point for income when you start your state returns. On this slide, we have a case study involving a software development company. With wage expense of 1 million, of which 500,000 qualifies, we would expect approximately 50,000 of federal research credits. On the next slide, we have an example involving a manufacturer. Their qualified activities include concept development, specification design, evaluating alternatives, prototype testing, and prototype refinement, and etc. With wage expense of 3 million, of which 800,000 qualifies, we would expect approximately 80,000 of federal research credit.
All right, so let's wrap up. So as far as tax planning items here, I've got a few bullet points here I want to address. One, we talked about electing the 280C on a timely filed return. And in doing so, you do not have to reduce your R&D expenses. Another way of saying that is electing 280C on a timely filed return, you do not have to add the amount of the credit back to income and pay tax on that. You take a reduced credit up front, and no adjustment to expenses have to be made. Now, if a client is a flow-through entity and they are not in the highest tax bracket, you may not want to elect the 280C. So the election of the 280C being beneficial is something that usually is for the highest tax bracket. So what I encourage you to do is to run the calculation with the 280C and run it without, and whichever is the best solution for your client, that's the one that you choose. Don't just automatically assume that the 280C is the best option. Also, if your client is in losses in a closed tax year, bumping up against an open tax year, let's use 2016 for example. If 17 is an open tax year, 2016 is a closed tax year. So if you had losses in 2016, there is revenue ruling and guidance that will allow you to go back to 2016, calculate a credit, and be able to carry that credit forward to an open tax year to offset tax liability. And we've included that on the slide there. Also, just to revisit AMT, starting in 2016, eligible small businesses can now apply the R&D credit against alternative minimum tax. So I want to talk a little bit about some IRS audit considerations. Number one, Treasury has an audit technique guide that is publicly available. It focuses on the areas that are commonly looked at under audit. I will say that our KBKG's final client deliverable seeks to address the most common questions that the IRS asks when conducting its audits. Number two, the IRS continues to target the use of estimates. Even though the courts have ruled on more than a few occasions that credible estimates may be used to determine qualified expenses. Also, oral testimony, so long as it's credible, may be relied upon to determine qualified activities surrounding its business components. And then number three, documentation supporting the R&D activities as well as the expenses related to the development continue to be a major focus of the audits. Although there is no clear guidance as to what constitutes contemporaneous documentation other than permanent books and records sufficient to establish the amount of the credit, I would say the more relevant the documentation is to the activities you performed and the expenses that you incurred, the better. And to that extent, what I'd like to do is to share with you this last slide showing really the sample documentation or examples of some contemporaneous documentation that we would request during the course of an R&D credit study. And really this is just to get a head start on if this is ever audited, that we have good documentation that shows that the 4-part test was met, and these were the people, the supplies, and the outside services that were paid for, and these activities incurred, and this is the evidence of that. So really what the IRS is looking for here is a nexus between the qualified projects and the activities, as well as the nexus between qualified projects and qualified individuals. So what I advise my clients is when it comes to contemporaneous documentation is look at where your qualified expenses are coming from. If you have highly qualifying individuals, software developers, for instance, let's say you've got 10 software engineers, that's all they do is they create code and do programming for new video games, let's say. So they're going to be nearly 100% qualified. And so if that's where your qualified expenses are coming from, then you want to focus your documentation on those individuals that are performing that research and get good documentation from them. On the flip side, if you are a manufacturer and you're let's say an engineering consulting firm, and you've got 4 engineers, 5 engineers, and you are developing these massive systems for customers where the prototype supply costs are dwarfing the employee wages, then that's where you're going to want your documentation focused. If the IRS or taxing authorities at the state come in, they're going to look at the low-hanging fruit and as to target and reduce your credit. And those are going to be those expensive costs. So make sure that you're tailoring your documentation and pulling that contemporaneous documentation to support the qualified expenses that you have. Another thing that I would say is highly paid individuals. You should be prepared to explain how that additional expense, wage expense, relates to the R&D work that was performed.
Michael's and Elisa's contact information can be found on this slide. If you have any questions about the material that was covered or would like to discuss an opportunity, please give us a call. KBKG also offers other webinars that may be of interest to you. I invite you to check them out at kbkg.com/webinars.